Good morning, I'm Clinton Griffiths coming to you from Ames, Iowa and Iowa State University's Research Farm as we wrap up our coverage as part of our College Roadshow. Now, ag economists here and across the country weighing in on the Federal Reserve's decision to put a pause on interest rates for now.
Are we a little higher in interest than, even if you look back over the last 50 or 60 years, are we a little bit higher than the history? Yes, we are. However, when you look at where many operations are from a profitability standpoint, they've been good, and they've been able to warehouse some cash to help them cushion some of this. They've also done an excellent job in locking in longer term rates that are on the lower end. So we're not talking about these higher rates affecting their total debt. We're talking about it affecting perhaps operating and maybe a little bit of equipment debt.
I think we're probably going to see some more increases from the Federal Reserve, but we've probably got the biggest increases behind us. But for a lot of folks, that's just going to start to hit home in 2024. That impact hasn't been felt yet by a lot of people, but it will be in 24. Producers are still relatively optimistic about farmland values, but looking at weaker farm incomes ahead, continued relatively strong interest rates, you have to think that by the time we get to maybe the end of 24, we could see some pressure on farmland values.
July's interest rate increase brought the benchmark lending rate to a 22-year high. So could the Fed be done raising rates, or is the battle against inflation still raging? Gloria Pasmino takes a look at the economic road ahead.
The U.S. Federal Reserve hitting pause on interest rate hikes as the central bank waits to see what impact previous increases have had on the economy.
We've covered a lot of ground, and the full effects of our tightening have yet to be felt.
But the break doesn't mean the Fed is done yet.
The possibility of another rate hike to come in either November or December is still very much on the table.
Though inflation is steadily slowing and the unemployment rate is relatively low, the U.S. economy is still contending with challenges that could hamper progress, namely high gas and energy prices.
If those prices are sustained at high levels, they can spill over into the prices of other goods and services.
Another factor at play, a looming government shutdown, with Congress showing no signs of reaching a federal budget deal by the deadline at the end of this month.
If they persist for any length of time, it really starts to act as a pretty heavy drag on the economy.
And while the Fed may be taking its foot off the gas for now, Bankrate.com's Greg McBride says not to expect lower interest rates anytime soon.
The Fed is going to leave interest rates at an elevated level for a period of time to truly make sure that this inflation issue has been eradicated.
In New York, I'm Gloria Pasmino.